And without further ado, it's my pleasure and honor to introduce Lucretia Young, State Director from AARP Delaware, to formally kick off the event and provide a few words of welcome. Lucretia, over to you.
Well, thank you, Colin, and good afternoon, everyone. And thank you for joining our Delaware EARNS webinar, A Brighter Future. As Colin mentioned, my name is Lucretia Young, and I'm the State Director for AARP Delaware, and it is certainly my pleasure to welcome you today. As many of you already know, Delaware EARNS is a retirement savings program sponsored by the Office of our State Treasurer. Here in Delaware, nearly 150,000 workers have no way to save for retirement through their workplace. This program has created a bridge for our state's retirement savings gap. AARP is a proud supporter of Delaware EARNS. It has been our pleasure to partner with our state treasurer, Colleen Davis, and her team, amongst others, to ensure that all Delawareans have a chance to save regardless of where they work. And for business owners that care about employees but struggle to offer a retirement benefit package, Delaware EARNS is the solution for you. Our state treasurer could not be here today. However, we have with us the Delaware EARNS Program Director, Mr. Ted Griffith, who will be sharing information and providing some answers to your questions. Ted, I'll turn it over to you.
Lucretia, thank you very much for the kind introduction. As was mentioned, my name is Ted Griffith. I'm the Program Director for Delaware EARNS. Delaware EARNS, sponsored by the Office of the State Treasurer, is a new retirement savings program for private sector workers who do not have access to retirement savings, payroll-based savings through their jobs. And before I jump into the presentation, I do want to thank very deeply AARP Delaware for all that you do for this. One thing that I've definitely learned in my job as program director is that you cannot accomplish anything on your own. Really takes great partnerships, and certainly that's been the case with AARP. Also, Treasurer Davis sends her sincere regrets. It just unavoidably was not able to join us today. I do wish that she could, because she was the true champion of this, help bring it to Delaware. And really, I would say without Treasurer Davis and without AARP Delaware and some important others, we wouldn't have this program that we do. All right, so I just want to talk first. I'm looking forward to discussing the details of EARNS with you, and really, very importantly, answering your questions now and going forward. But just want to provide some helpful context. First of all, what's the goal of this? What are we trying to do? So it's really twofold. The first is Delaware EARNS is about improving the quality of life for our workers here in Delaware. And we're doing that by giving them the opportunity to save for retirement through their jobs. Secondly, and also importantly, this is about making sure that our small businesses stay on a competitive footing with the surrounding states. So already, most of our neighbors, Maryland, Virginia, and New Jersey, have this type of program up and running. Now, Delaware EARNS is a government program, but I would say it's really a different kind of government program, because it doesn't benefit just one constituency. It will benefit the entire state. So number one, for employees, it gives them a chance through payroll to save for a better future. So it's going to greatly increase their retirement security. For employers, for private sector employers, it allows them to offer a competitive benefit at no charge to the employer. We do not charge any fees to employers to facilitate EARNS. And then I'm imagining virtually everybody on this call is a Delaware taxpayer. This will benefit all of us. We have the potential, if you will work with me and make sure we reach as many people as we can with Delaware EARNS, we have the potential to save tens of millions, even hundreds of millions of dollars over a long period of time. And that makes sense if you think about it, because if somebody goes into retirement with a healthy nest egg, they are that much less dependent on expensive government services. You may ask yourself, well, why is the state getting involved with something that's traditionally been solely the domain of the private sector? And the answer is we are facing a retirement crisis, as you may know. Probably the vast majority of us are not saving enough for retirement, but a very substantial portion of the population is saving nothing whatsoever. And so that's a demographic time bomb that will go off every year as people reach retirement. But under Treasurer Davis, in her office, we want to go beyond just saying, hey, there's a problem. We want to try to do something about that, to offer a solution. And something that has been shown to really move the needle is to give workers the opportunity to contribute to retirement through payroll. It sounds very simple, but just doing that, this is something that our great partners at the AARP were able to highlight and discover. If you have the opportunity to save for retirement through payroll, you are 15 times more likely to do so. So I can't think of many things that would, in such a significant way, improve the situation. 15 times. All right, for the balance of the presentation, I want to really dig into the details. Again, looking forward to your questions, happy to answer them. I'm going to be talking about how this affects both employers and employees. So starting with employers, this is a mandatory program for employers that meet the 3 criteria that you see up here on the screen. So if you have 5 or more W-2 employees, full or part-time, and you have no qualified retirement plans, such as a 401k, and you have been in business for at least 6 months, you are required to facilitate this program, make the payroll contributions. And you do need, please, as soon as you can, to go to earnsdelaware.com and to register. So if you check all 3 of these boxes, you are required to facilitate Delaware EARNS. We often get questions, very good ones, about, well, what kind of retirement plan would qualify me to be completely exempt from Delaware EARNS? And it's the standard list of retirement plans that you see here, starting with your 401ks, including 403bs, which are very prevalent in the nonprofit world, but it's the standard list of qualified retirement plans that I imagine many of you are familiar with. And of course, we have this list on our website for your reference. But if you have any questions, just ask. Probably also a good moment for me to point out, Delaware EARNS in no way is meant to compete with private sector retirement plans. We are not trying to displace private sector retirement plans, just the opposite. So if you're an employer and you have one of these qualified plans in place, please keep it. It makes you exempt from the EARNS requirement. All right, turning now to employees. As I mentioned, it is a mandatory program for employers. At the employee level, it is entirely voluntary, but it's voluntary on an opt-out basis. And what I mean by that is if someone does not want to participate, they have to go in and opt out. If they don't opt out, automatically a 5%, equal to 5% of their gross paycheck, will be deducted and go into their Roth IRA. So it is voluntary, but if someone does not want to participate, they have to actively opt out. And you can see here the criteria for being enrolled in the program. I should say we also get questions about, well, what about this automatic enrollment? Why didn't you do it the other way around? This really reflects best practices in the retirement planning field. I spent most of my career involved in one form or another in retirement planning. Increasingly, and you're seeing this in the private sector, people are being automatically enrolled into the program because they need a nudge to get started with retirement. If you put up any barriers at all, people are apt not to do it. So that's why we do the automatic enrollment. So this is a very timely, thank you for tuning into the webinar. It's very, very timely for you. This is the key period for Delaware EARNS. On July 1, we opened up for employer registration. So you can go to earnsdelaware.com right now as soon as you get done with the webinar and register. The deadline that is actually coming up fast is October 15th. So if you walk out of here with anything, it's this deadline, October 15th. By then, you have to go to earnsdelaware.com and register, or if you got a notice and you have a retirement plan, to certify your exemption. All right, so as I'm explaining, of course, this is a new program, so inevitably, there's going to be some misconceptions that emerge about the program. And probably the most important one, the most important myth for me to clear up is that the state of Delaware is requiring employers to buy a retirement plan. Nobody is required to buy a retirement plan. As I said, we will not charge employers any fees for facilitating Delaware EARNS. You can, if you choose to comply with the requirements, go ahead and purchase a 401k or a simple IRA, so forth. But that's just one way to do it. You can do it without any fees to you by facilitating Delaware EARNS. And I also want to take you into, I think also because it's a new program, there's a little bit of apprehension that this is going to be difficult to administer. That is not the case, especially relative to a traditional qualified retirement plan. Very easy to administer. There are really only 3 steps that the employer has to go through. And I'm going to actually provide you detail on each one of these 3 steps, but I just wanted to lay them all out here. The first step, the one we're asking you to address basically right now, is going to earnsdelaware.com and registering. So what you'll do is you'll go to the website, you will put in your EIN. You should have also, hopefully, in a letter, received a unique code to your business. Now, if you do not have this code, it is not a problem whatsoever. When you're on the website, you'll be able to see, you just put in your EIN, and you can get the code back by just entering your EIN, as I say. If that doesn't work, it's not a deal breaker either. You simply write to us or call us. We'll generate the code for you. So if you don't have that code, it's not a worry. All right, so you've entered your EIN and your code. You're now in to the employer portal. You just like you would with any account, you set up your ID and password. You're then, as part of the registration process, adding information about your company, bank information, your payroll process. And then the last piece of the registration to complete step 1 is you will securely upload information about your employees to earnsdelaware.com. So you have to upload information about employees who are covered by the program. And then we step into the process. We're the ones that will notify employees. They will receive either emails for us, or if we don't have an email, they will receive a letter from us, letting them know, back to the auto enrollment point, letting them know that unless they take action in 30 days, they will start to see deductions from their check equal to 5% of their gross check going into their Roth IRA. So unless they opt out, that's what's going to happen. And they have this 30-day decision period before anything would happen. They can always opt out later if they like, but this is a 30-day period before anything at all will happen. Once that 30-day period has elapsed, that's when you begin, as the employer, coming back to the employer, that's when you begin the payroll contributions. You will need to set up a deduction in your system. I've had some people equate it to like an HSA deduction. You'll need to create that in your payroll system. And going forward, the first time obviously, but going forward with every payroll cycle, you'll need to send in those contributions. It'll pull from your bank account. And you also need to upload a template through earnsdelaware.com securely, breaking down everybody's contributions so it can be matched up. I want to pause here too, just for a moment and say, what I am describing is the absolute most you would have to do in terms of administration. In many cases, some payroll providers are offering what they call an integration. Basically, if you're working with a payroll provider, they take over some or all of the steps involved with this. So again, please go to earnsdelaware.com, check out, there's a lot of great information on the payroll providers who are offering these integration services. It's even possible to designate a third party to, once you get in, to designate a third party to administer this for you entirely. But I'm just giving you the kind of the scenario in which you would have to do the most administration. And then the final step, completely logical, you're just going to have to maintain it, right? To stay in compliance, it's not just like a one-time contribution. Every time you're running payroll, you're sending in these contributions. Obviously, people will come and go from your employee. You need to make sure you're updating the roster accordingly. And that's it. Those are the 3 steps involved. If you look at a qualified retirement plan, there's probably 18 separate steps that you would have to go through. With Delaware EARNS, again, you will not incur any fees from us. We don't charge anything. As I mentioned, I've been around retirement planning for a long time. I am not aware of any other retirement benefit an employer could facilitate without fees to the employer. There is no matching also. So again, no out-of-pocket cost to the employer. There's no matching. And in fact, for certain legal technicalities, no matching is allowed. So even if you wanted to, you can't match through this program. If you're interested in doing the match, then probably best to explore the private sector retirement plans. And then the middle point, I realize sounds very dry and technical, but is significant to employers. You do not have any plan sponsor liability associated with Delaware EARNS. You should be aware if you offer a 401k, which is a great thing to do for employees, an employer does assume a degree of liability when they do that. They have to have ensured that the fees and the investments provided through the sponsored plan are reasonable. That obligation does not exist with Delaware EARNS. This is a state-sponsored plan. All right, coming back to the employees, as I said, we will drive the communication. So letting them know about this 30-day decision period, letting them know that they've been enrolled. If they take a withdrawal, they receive communications about that. They receive quarterly statements from us. We're driving the communication. And again, I think, as I mentioned, we're using Roth IRAs. That's where the money is going into. These are Roth IRAs in every respect, including the contribution limits that you see there, annual contribution limits. Those limits do change from year to year, but that's what they are for this year currently. So just as we have worked really hard to make this as easy as possible for our employers, for our great small businesses, we are also striving to make this as easy as we can for employees, for the savers. And we've done that by creating a default path. So if somebody makes no elections whatsoever, they end up with a pretty good outcome. The Roth IRA gets opened for them by default. They get a contribution rate of 5% of their gross check set for them. And then the money goes into a target date retirement mutual fund, which some of you may be familiar with. These are very appropriate investments for long-term retirement savings. They actually adjust their mix of the underlying investments automatically on behalf of the participant. So they don't have to get in there and be hands-on as an investor. So again, this is all about making it about automatic enrollment, default settings to make it easy for employees. Of course, we also welcome if they want to be a little more hands-on, that's fine. If they would like the traditional pre-tax IRA where you can deduct contributions, they just fill out a form and they can do that. That's no problem at all. Likewise, the 5% is not set in stone. They could, ideally, actually, folks would, if they could, save 10, 15% for retirement. We just recognize that for many, many people, that's not realistic. But for those who it is, they are free to increase that contribution rate. Likewise, if somebody can't do 5%, I would hope that they would consider maybe even just 1%, at least create the habit of saving and investing for retirement. And then lastly, on the investment side too, there is the ability to customize the investments from a short list if you want to go beyond the target retirement fund. There are some other mutual funds that can be used. All right, I believe I've touched on all of the points here, but I do want to come back to the Roth IRA and just expand on that a little bit. As I mentioned, Delaware EARNS is a different kind of government program. It's also a different kind of retirement program. And that's because, as I say, it is built on the Roth IRA. Now, as you may know, most retirement plans, defined contribution retirement plans, are on a pre-tax basis. They call that the traditional way of doing it. In this case, contributions are going into the Roth IRA on an after-tax basis. And really, for the audience that we're serving, the public that we're serving, the Roth IRA is, generally speaking, going to be the perfect type of account. Number one, it's very portable. The Roth IRA is universal in this country now. If they change jobs, it's easy to take it with them throughout their lives. Likewise, they can leave it with us if they wanted to when they change jobs. Further, again, making it easy on employers in terms of portability. Once someone leaves your employ, you don't have to worry about what happens to their Roth IRA. That's on us. We'll stay in contact with them. Secondly, back to the point about recognizing that people are under a lot of financial pressure. We see a lot of inflation, a lot of rising costs. We do recognize that there may be situations, there's an urgent situation, and the saver needs to tap into funds in the Roth IRA. At any time, somebody can withdraw up to the amount that they contributed to a Roth IRA without taxes and penalties. So in other words, you put $100 into a Roth IRA. At any time, you can withdraw that original, not the earnings, but the original $100 at any time can be withdrawn without taxes or penalties. So if there's an urgent situation, they actually have some savings on the side that they can access if they really need to. Thirdly, and this is potentially very powerful, there are some long-term benefits, tax benefits associated with the Roth IRA that you should be aware of. We're talking about withdrawing contributions tax-free. With the earnings, once you're old enough, so 59 and a half, and once you've had the account open long enough, which is 5 years, you're even eligible to withdraw all the earnings completely federal income tax-free and state income tax-free. So what that means is we have the potential, if we can reach people early enough, if you'll help me do that and get them saving, even if, say, for example, they saved just $40 a week for their entire working career, and they got about an 8% annualized investment return, which is not, it's a good investment return, but it's not out of the ordinary at all. That person that was saving $40 a week for their working life would be sitting on more than $500,000 when they retired, which they would then be able to draw on again, without federal or state income tax, and the higher tax rates go in the future, the more valuable this benefit is. So that's why Treasurer Davis says we really do have the potential to change the quality of people's lives. I know it seems a little silly to be excited about a retirement plan, but that's why we're excited about this. All right, so just a couple of quick points to recap. Again, we put a lot of focus on small businesses and assisting them. I think sometimes in me talking about that, I don't want to lose the fact that this very much is open to and in fact required of our nonprofit. So again, if a nonprofit has 5 or more W-2 employees, no retirement plan, they do need to facilitate this. So it absolutely applies to nonprofits as well. And as I mentioned, of course, this is a mandatory program. And so, on paper, there is the potential that administrative fines, penalties could be levied against employers. I should say we are very much approaching this. Treasurer Davis is always encouraging me to approach this in the spirit of partnership with our small businesses. I really don't see any reason why you wouldn't facilitate this program. Again, it gives you the ability to offer a competitive benefit. We don't charge you any fees. So I am hopeful as the program director that it would never come to this. And certainly right now, what we're focused on is outreach, answering people's questions, and generating awareness. All right, so we're very much looking forward to your questions, but as I said at the beginning, and it could not be more true, it's really impossible to accomplish anything on your own. In addition to the AARP, which again have been a fantastic partner, we have and you see them up here, so many great partners who let you know about this webinar, but in countless ways have been so supportive of this, and we're really grateful to them for doing that. And one of our special partners is Stand By Me Delaware. Laura Gendreau, who kind of leads things over there. It's a great financial education group. I'm going to just want to give Laura a chance to speak to you a little bit about what they're doing, and then again, we're really looking forward to your questions. So Laura, I'll take it away.
Thank you, Ted, and thank you, AARP, for all that you do. We are excited to be a supporter of Delaware EARNS. And let me just say that we have been supporting the work that Ted and the treasurer have been doing. So in that support, I am honored to manage the day-to-day operations of Stand By Me, in which we provide free financial coaching for our fellow Delawareans. We have instituted that every single customer who interacts with the coach is asked, do you currently have a retirement savings? And if you do, awesome. We are promoting that. But if not, let me tell you a little bit about something about Delaware EARNS. And then we're sharing the information about Delaware EARNS with our coaches as well as with our customers. Having a statewide footprint allows us to see many people throughout the state. Having multilingual coaches allows us to have that conversation in not only English, but Spanish and French Creole. So we are having the conversation. We are encouraging them to move forward, to benefit from Delaware EARNS. We're providing the link. We're providing the information. Ted has kindly provided training for our coaches as well as for our minority small business program. Underneath the umbrella of Stand By Me, we also have a program specifically dedicated for minority small businesses. Within that program, we also are encouraging business owners to look into Delaware EARNS as an option for not only them, but for also their staff. So we thank the AARP, we thank Ted and Delaware EARNS, and as we move forward to improve upon the retirement savings of our fellow Delawareans, please know that Stand By Me is a supporter, a promoter, and we are here to be of service. So thank you.
Laura, thank you so much. And I'm just going to very lastly, I'll leave this up during the Q&A. This is our contact information, starting with earnsdelaware.com. You can also, any service issues, please use that email that you see there, clientservices@earnsdelaware.com. This is also, as you see, overseen by the Office of the State Treasurer. So if there's any issues, write to us at earns@delaware.gov. That's how you reach the Treasurer's Office. That comes to me and my colleagues. So we'll respond back to you. I should have also mentioned that in addition to the website, the call center is up and running right now. So you can call, if you're an employer, you call that number. If you're an employee, a saver, you call that number. Very importantly, obviously, we have a significant Spanish-speaking population. This call center is bilingual, so Spanish-speaking business owners or workers, that's not a problem. We'll get their questions answered. Likewise, a good part of the website is now available in Spanish, so we really want to reach everybody. Again, as I say, looking forward to your questions. But if you're like me, you always think of the question the day after. So don't be shy about reaching out afterwards when I answer the questions today. But anything we can't get to or anything that comes up later, we're happy to address. So thank you so much for your time today.
Well, thank you, Ted, and thank you for that wonderful overview. I think I always learn something new when I listen to you, and I'm excited to kind of get into some of the questions that we were receiving during your presentation. The first is from Alex, and kind of wondering how will organizations and businesses kind of get notified about this deadline, about their access codes. If we could talk through that process so folks know what to look out for as the deadline is upcoming.
Certainly, and appreciate the question. And back to the point about partners, we have worked, and it's been very helpful with the Delaware Department of Labor to identify employers that we believe are affected by EARNS, and letters have been going out to the addresses that we have on file. So we have been sending out letters. We will continue to do so. In some cases, you might not have received a letter. That might be because for whatever reason you weren't on the DOL list, or we might have had a wrong address, or in some cases, people have arranged with the DOL to have their mail go to kind of an agent. So if that's the case, if you don't normally get mail from the DOL, check with whoever your agent is that you've designated. If you don't receive that communication, though, again, it is not a deal breaker. Just go to earnsdelaware.com. As I said, you can easily access your access code, pardon the pun, by putting in your EIN. If for some reason the access code still does not come up, please just give us a call or write to us. We'll make sure you get that code. And so that's, obviously we're also doing, in addition to the statewide numerous communications, we're doing as much outreach as possible, and any opportunities we can have to do that outreach, we welcome. As I said, really, we do want people to take the deadline seriously, but we're also realistic. We're not breaking down anyone's door on October 16th. We just want you to be aware of this, take action. This year is really about driving that awareness, and anything we can do to help, or any suggestions you have that would help, we welcome.
Thank you, Ted. We got a question from Michael who asks, is there a tax benefit for employers who participate?
There is not. These are after-tax contributions, and I know something that also comes up. There can be tax credits associated with offering a 401k. Those credits are designed to offset the cost to the employer of offering the program. Since we are not charging any fees, there wouldn't be necessarily, the tax credit wouldn't be as applicable. But so there's no tax credits for facilitating Delaware.
Yep. And I know you already mentioned the penalties, Ted, and that you all are not, that's not your primary focus. That's not what you all are focused. But I do want to just remind folks again what those are, because we did get a question about them.
Sure. So And again, right now, especially, the focus is on notification, helping people, answering questions. If we did ever get to a situation where someone was refusing to facilitate the program, again, the employees don't have to contribute, but employers that meet the criteria that I talked about, they do have to facilitate the program. The potential administrative penalties after you go through the process is $250 per employee, up to $5,000, capped at $5,000 per year. So it would really be unfortunate to incur those penalties. They're significant, and we recognize that. And again, we're not doing this lightly or punitively, but people should be aware. You have to take this seriously. It's a mandatory program, but we're here to help. I mean, I think that's the great thing about being a small state is we're your neighbors, your friends. We want to help you do this. We're not doing this to ding anybody.
And Ted, if you could remind folks, just to be clear, that the requirement is to offer a qualified plan. So it could be earned or it could be 401k or other. Is that correct?
That is absolutely correct. So if you have a 401k, because another kind of a related question to that, Colin, is, hey, we have a 401k, but unlike earns, it doesn't cover part-timers. Do we have to facilitate earns for those part-timers? No. If you have the 401k, the 403b, the simple IRA, the SEP IRA, the 457, the whole alphabet soup of them, if you have that in place, the old school defined benefit pension, you are completely exempt from earns. The most we will ask you to do, if you get a notice, but you actually have a plan, you just go to the website and you just certify a test that you're exempt from this. So very good clarification, Colin. Remember, the criteria are you have 5 or more Delaware W-2 employees, and you don't have a qualified retirement plan, and you've been in business for 6 months. So it's those, you have to check all 3 of the boxes for this to apply to you.
No, thank you. I have a question here about tipped employees and how earns interacts with them. I'm considering that their net pay will look different.
Yeah, it's a great question, and it certainly is an issue that will come up. And the solution may depend on the specific situation. One possibility, and probably in the likelihood in the future, we're more likely to see this, is to have those tips incorporated into the paycheck. That might be one solution. The other solution is if in a particular period, because of other charges and the tips not being included in the paycheck, if somebody's not able to contribute, again, it's voluntary on the employee basis. They don't have any obligation to contribute. So if they're not able to contribute in a particular pay period because of the way things shake out with what's left over in the check, that's not a problem. They can just continue doing it later. If it's something that happens all the time but they really want to contribute, it's very easy to go in and link up your bank, your checking account with your account. In fact, I would encourage, it's a great idea for all employees. As soon as they get enrolled in this, go to earnsdelaware.com and link up your bank. As you can see, I'm not a young guy, but I was able to do this. I tested it out myself. Very easy to do, to link up your bank. So I'm thinking of that tipped worker, if they really wanted to contribute, and they had the money to do so, but it just wasn't showing up in their check, they could make regular contributions electronically through their bank. And there's also, if somebody wants to write to me at earnsdelaware.gov, I actually have sort of some background that was developed by a payroll provider that has some more technical things on what to do with the tipped employees that I'd be happy to share.
And then Ted, we got a question a little bit about the kind of back end, how earns is set up and the governance structure. Would you be able to talk a little bit about the earns board and what that looks like and how that interacts with the program itself?
Certainly. And I'm sure everybody on this call has heard that, public-private partnership. You've heard that a lot. In this case, it really is an exceptional public-private partnership. So sponsored by the Office of the State Treasurer, overseen by the Office of the State Treasurer. Further, though, As Colin said, we have a great board of community leaders and governmental leaders who are overseeing me, making sure everything is being done right. So a lot of great public oversight of this. The actual administration, the running of the call center, the operation of the website, the tracking people's transactions, maintaining the cybersecurity, that is done by a very responsive private sector company that specializes in these things. The company is called Vestwell. There are 10 states currently that have, including us, that have these kinds of, they call them auto IRAs, that have them in place. The company we're working with, Vestwell, the private partner in this case, they are the administrator for 8 of those 10. So they have really demonstrated they know what they are doing when it comes to these kinds of plans. So we think it's a nice combination. I've heard feedback. I was just with the Contractors Association this morning and was talking to some HR folks. They mentioned that they have called in and so far so good. It's been very responsive. That's what we want to hear. So please reach out to them to take advantage of the resources that are there. If there is an issue, however, I know new program, there's going to be issues come up. The treasurer's office can get involved if need be. So like I say, nice balance of public and private. And just one more thing on that, we also get a question about, well, who's doing the investments? I think, as I mentioned, the target date retirement funds are through State Street Global Advisors, which is one of the largest asset managers in the world. So those are the primary investments. State Street also provides some other investments through the program. These would be the customized ones that no one would default into them. And then there's one more investment. It's if somebody wanted to be kind of on the aggressive side, again, it would not be appropriate as a default investment, but if they really want to do it, they can do it. That's through a company called BlackRock, which is actually the world's largest asset manager. So we are dealing with, these investments are from the very biggest asset managers in the world. Billions and billions of dollars invested in these mutual funds. So we feel confident about that as well.
And then kind of a quick clarification question. The 30-day period for employees to opt out, does that begin on October the 15th when a business registers, or would that begin when contributions would start? And when would contributions start for a business that signs up on the 15th?
Great.
Oh,
sorry, I had a little mute issue. Can you hear me okay? Great. So the question was about this 30-day period. So the 30-day clock, if you will, that starts running once the employer has registered. So back to that first step where you're uploading information about your employees, that then triggers us to reach out to your employees to notify them about this. And that's when they're told you have 30 days in which to opt out, or you'll start to see these contributions come out of your check. So that's when it begins. In truth, it's probably going to be more than 30 days because it's 30 days plus your next payroll cycle. So if I know in some cases it's probably unusual, but in some cases it might be a monthly thing. So it might be another month. You might have weekly payroll, so it might be another week. But there's 30 days before anything happens. Once that 30-day period expires, though, you as the employer have to start sending in the contribution. So it's 30 days from registration. When the employer completes the registration is when the clock starts running. So if you did it October 15th, that would mean your next pay cycle after November 15th.
we got a question about how do you determine eligibility for savers regarding the Roth IRA? So there may be some folks who aren't eligible for Roth. And so how does EARNS approach that? And I think it might be helpful, Ted, to remind folks about the Roth IRA and kind of why that vehicle is chosen and kind of benefits that it brings for anyone's contributions.
Sure. And also it has to be noted that the Roth IRA, as you may know, is named for our late Senator William Roth of Delaware, who was a longtime Delaware senator. So that's not why we're using it, but it's a nice little piece of local color. Yeah, in terms of the questioner is obviously very knowledgeable. You should be aware there are income eligibility rules for a Roth IRA. In other words, if you make too much money in the eyes of the IRS, not us, but the eyes of the IRS, you are not eligible to contribute to a Roth IRA. So it's, I want to say, don't quote me on these figures, but starting at like this year, and again, they change every year, but it's starting at this year, a single filer with $146,000 in modified adjusted gross income, they start to lose the phase out the ability to make Roth contributions. Likewise, for joint filers, it starts around 230,000. So there are income eligibility limitations for contributing to a Roth. Generally speaking, in states where this has been done, again, Delaware is by no means the first to do this. There are 9 other states doing this. Some of them have been doing it for a long time. Generally, with the population we are serving, this is not an issue, the income limits. That's not to say it will not come up. I'm certain it will come up. If it does come up, it is not a big deal whatsoever. The person just, as I think I mentioned, the person could just fill out a form and have it. The technical term is recharacterized. You can recharacterize your Roth IRA to a traditional pre-tax IRA or even a non-deductible IRA, which anyone can have. So if that does come up, and I'm sure it will, if you're through those income limits, you can simply just recharacterize the Roth. And again, the Roth IRA for the, generally speaking, for the segment that we're serving is really ideal. Again, highly portable. You can take it anywhere. You can leave it with us. We're happy to have you leave it with us, but you can take it anywhere. You can tap into those original contributions. Now, with a pre-tax traditional IRA, you make a contribution and you want to get at that, you're going to pay taxes and penalties if you're doing it even on the original amount you contributed, unless there's some kind of exception or something like that. But so in a way, the money's kind of walled off in the traditional IRA. With the Roth IRA, the contributions, the principal, if you will, not walled off at all. No taxes or penalties to get at the original contribution. And then third, and it's very speculative as to what would happen with taxes in the future. But I would imagine if everybody on this call had to make a bet, they would bet that taxes are going to be higher in the future than they are now, tax rates. If that plays out, then the Roth IRA becomes even more valuable. Because remember, if you're old enough and you've had the account open long enough, you're going to be able to tap into those earnings completely federal and state income tax free.
Cool. And then a few questions about payroll providers and the list of payroll providers that are participating. And so Ted, can you remind folks where they can find information about their own payroll providers, and then some questions about the payroll providers and how they kind of operate with this program?
A very important question. And so please go to earnsdelaware.com. There's a lot of information there around payroll providers. We do list those payroll providers who are so-called integrated with Delaware EARNS, in which they would take some or all of the steps completely over for you. Your payroll provider would do that. There's a lot of variation that we're hearing among the payroll providers. Some are integrating and not charging anything additional to do that. Some are integrating and charging some extra fees. Some are doing it for their clients, and some are completely hands-off. Some of the larger ones are sort of hands-off. That won't stop you. You can do this on your own, absolutely. We have, for some of the bigger payroll providers, ADP comes to mind. We actually have on the website instructions specific to ADP, because that's a bigger one of what exactly to do. And we're going to be continuing to build this out and offer more services. In some cases, we are hearing payroll providers are charging to help out with this, and that's that's a business decision by them. And if they're providing a service, they should be able to charge for it. But you can shop around. As I say, I think there's some payroll providers that are providing the support without additional cost. So, it always depends on your specific situation, and I'm not, encouraging one payroll provider over another. But we are providing a lot of information on the website right now about that. Always open to feedback on what more we can do to assist.
Thank you, Ted. Some questions about part-time workers. I wonder if you can talk a little bit about part-time. And again, just a quick note that employees, savers are not required to participate. They can opt out at any time. There's no requirement associated with employees or savers. Is that correct?
That's absolutely correct. And we certainly do recognize, when I was saying, hey, this is a great thing for workers, we recognize, I've gotten some feedback that, so-and-so is retired and pretty long retired. They're just doing this job to kind of keep themselves occupied. Obviously, a retirement account does not make sense in that specific situation. They should opt out, or if if they don't have the money to do it, we understand that, we recognize that. They should just opt out. Completely voluntary on the employee side. And this is a good opportunity for me just to come back and talk about employees that are affected by this. So we are saying, if you're sending them a W-2, a Delaware W-2 for Delaware income taxes, even if they only work for you a few hours, so very part-time, they do need to be registered for this program, and then they can opt out if it doesn't work for them, but they do need to be registered. That's what you don't have to make anybody do it, but you as the employer have to register them, even if they're only W-2. Now, 1099s are out, but if they're W-2, you should be enrolling them, even if it's only, like I say, very part-time. One thing that I did not mention that's not specific to part-time, but is around seasonal. Basically, if under our regulations, the way we have them now, seasonal employees can be excluded from this. Well, everybody would define seasonal a little bit different. We define it as 120 days. So if somebody never works, so just an example of an employer at the beach, somebody's working for them June through the end of August. So that's 3 months versus, or even a little more. That person, that specific employee, the seasonal employee who does not work, is not in your employ for more than 120 consecutive calendar days, would never have to be enrolled in this. So that's there's no exception for part-time specifically, but if somebody doesn't work for you more than 120 days consecutively, which works out to about 4 months, they don't ever have to be enrolled in EARNS. So we do give a seasonal exception.
I want to kind of batch a few questions because we're a little bit on time. But they're related to one question is, how will employees access or view their statements? They need to go to a portal to sign up, or will they get monthly statements? I think there's also kind of a question related to, whose job is it to kind of inform the employees about all these changes, about all the information about EARNS? Does that go on the employer at all?
There is no legal obligation for employers to educate people about the stock market or taxes. We are driving the community. This is not an employer-sponsored plan. It is state-sponsored. So we will drive the communications. There's no problem with you, and it probably is in everybody's interest to give folks a heads up that, hey, the state's making me register you guys for this. Look out for the emails. If you don't want to participate, just opt out. So notifying employees about the program is like I say, it's probably in everybody's interest. But you don't have to be our cheerleader. You don't have to go out and say, oh, you have to sign up for this, or you have to contribute to this rather. Vice versa. Please don't get involved with discouraging people from participating. You can mention it to them, but as I said, there's less liability on the employer with this than there would be with the qualified retirement plan. So we will be driving the communications. Right now, of course, as you can tell, our focus is on reaching employers, just making them aware of it. Looking forward, we're going to, increasingly try to do employee outreach. If I can, I'm happy to come to your place of employment. We're going to be doing webinars for the employees. Right now on the front burner is just we got to let the employers know. But this is going to be around for a long time. And as the years go by, more and more of our emphasis is going to be reaching the employees once the employers are all aware of it and accustomed to it, educating people. And as they start to build up money in that account, they'll see the value, and we look forward to educating them about it.
Thanks, Ted. And how will the employers be notified if an employee opts out? Will they have to check the EARNS website, or how will kind of employers get that kind of closed end communication loop?
Certainly, and we provide a twofold notice to the employees. So remember, we were talking about the registration step. When you first sign up, you provide information about your payroll cycle. 4 days before payroll is due to run, we will send you an email letting you know of any changes, folks that have changed their contribution rate, that sort of thing. If you miss the email, that is not a big deal. But every time you run payroll, if you're doing this, on your own without the payroll provider, every time you run payroll, you do need to be logging into the earnsdelaware.com portal. When you log in, front and center, it will show you who the so-called active employees are, not in like they're working for you, but active as in they didn't opt out. People that opted out will show under a different category. You wouldn't even see them. If somebody changes their contribution rate, you'll see that as well. So you do need to be going to the portal as part of running the payroll, earnsdelaware.com, and it's very clear there. It's highlighted right in red. And again, just to put in a plug for the website, earnsdelaware.com. There's 2 videos. One that walks you through the registration process. It's 5 minutes. So that's, the registration could be just 5 minutes. There's a second video that shows you, running the contributions and how your employer portal is set up so that you see any changes that occur.
And we have a few more, so we're gonna do rapid fire, but just also I want to kind of ask and remind, my understanding is that a business would be able to, a business owner would be able to deputize someone to kind of help them. So if they have an account manager or bookkeeper that they work with, they could go in the system for them. Is that correct?
That is absolutely correct. When you first, as the employer, when you register, I think really the only step you would absolutely have to do is just the going in, putting your EIN and registration code. I think as soon as you get in, you have an option to basically create a third party that you can delegate it to, obviously somebody you trust, because you still have the responsibility that it get carried out. But absolutely, you can do that. That's not a problem.
All right, well, we're gonna go quick rapid fire. So first is 5% the minimum contribution, or folks can go lower than that if they need to?
They absolutely can go lower than that. That's the default contribution, but they can go down to as little as 1%.
Are employees able to make separate extra contributions on their own?
Yes, they just have to link up their bank account.
All right.
Or arrange with you, the employer, to do it.
Perfect. And then, so it's on the employee when you were talking about the kind of Roth IRA versus traditional eligibility. It would be on the employee to make those changes, not the employer.
Yes, absolutely.
And I think that is it. We have one last question, which is, does this program now prevent higher income individuals from doing a deductible IRA because their employer doesn't offer a plan?
No, it's not a, no, I don't believe so. What the person's referring to is if you're over certain income limits and you contribute to a workplace retirement plan, you may not be able to make a deductible IRA contribution on your own. And I guess that's so certainly if you didn't participate, so if you opted out of EARNS, you would be able to make that deductible contribution. I guess we're really into a technical area as to if you didn't opt out of EARNS, would you still, and you were over and there are different income limits, would you be able to make a deductible IRA? And that's almost like they call it the private letter IRS ruling. But if someone was concerned about that, like, hey, I want to still be able to make my deductible IRA contribution, it's kind of a high class problem to have, that just opt out of the EARNS.
Well, Ted, any final thoughts or comments? And a thank you to everyone for joining us today. I know it's a little kind of getting through all the details, but this is important as we're looking down the October 15th deadline. But Ted, over to you for any kind of final comments and a huge thanks again to AARP Delaware for all their work behind the scenes pulling this together.
And just to echo what Colin said, I cannot stress enough how AARP Delaware has really been such a fantastic partner and really kind of deserves credit because they're thinking about the future members. They're not just worried about the current members, including yours truly. They're thinking about the future. So they deserve a lot of credit. But really, I want to thank all of you. I know everybody is super busy. There's a lot going on. So thank you so much for taking the time. I realize it could get pretty dry pretty quickly, but really thank you for your thoughtful questions. And we're here to help in any way we can. So just want to express my appreciation to all of you who took time out of your busy day to be part of this.
Wonderful. Well, thank you, Ted. This is now the end of the webinar. We will follow up with the recording so folks can reference that, as well as the information and resources Ted mentioned, so that folks have all the most up-to-date information as the deadline begins. But thank you for joining us and have a great rest of your day. Bye now.
Thank you.